So it's been a moment. So real quick review of just what we covered. Some complicated formulas, but we learned how to use the TVM solver for the most part to solve this. So this is your savings plan formula, where A is the accumulated amount in your savings account when you're making regular payments at a regularly scheduled interval. So we have kind of the key down here as to what all of these mean. You can use this formula by hand. Of course, it does work, but that is pre-programmed into your calculator in the TVM solver, which is probably a little bit easier to use. In an example, we talked about what an annuity is. So it's any series of equal regular payments. So like an IRA, individual retirement account, is generally an annuity where you just have some amount scraped off the top of each paycheck and dumped into a retirement account for you every time. We talked about total return and annual return. So these are good examples of like formulas that you can't just use the TVM solver for and you would have to do by hand. They're pretty straightforward formulas. You could still use your calculator, obviously, to input them. But if you're asked for the annual return on something or on an account, you would want to find this formula on the formula sheet and then pop the appropriate values in for A, P, and Y, and then you would get a value back. All right. And that was the last example we did. So we're going to talk about types of investments now. So we're going to talk about stock first, and stock, as you probably know, gives you a share of ownership in a company. And so just the most basic idea is you're going to invest some amount to purchase the stock. And then the only way you get your money out is to sell the stock. And stock prices change over time. So if you bought it lower than you sold it, then you made money. If you sold it lower than you bought it, then you lost money. All right, this is a definition with a bunch of words on the page, and I don't want to stress you out. So just give me the hand raise emoji when you got it. So I'm sure that the basics of the stock market aren't all of that confusing, like when you just look at it like this, right? But as you probably have all seen with the like whole GameStop thing and the way that the market has been in the news and all the different ways that you can invest, it gets confusing really quickly. And so actually at the end of this unit, my dad is going to come give a talk to close it out on specifically investing and like what the easiest way to do and the safest way to do that is. So in general, the least safe thing you can do is invest in a single company because that's the highest risk. And you are the furthest away from the information about that company, meaning you are a consumer. And there's all sorts of people who are on the inside whose job it is to know about what that company is doing and to analyze whether that company will go up or down. But that is not you as a general consumer. And so because of that, you're taking the most risk when you invest in a single company. And we'll talk about different ways that you can invest in the stock market that are relatively safe. All right, so a bond represents a promise of future cash. You buy a bond by paying some principal amount to the issuing government or corporation, and the issuer pays you simple interest as opposed to compound interest. So remember, simple interest is only being paid on your initial investment amount. So you will be earning interest, but if you invest $100 for 5 years, you're only earning interest on that $100 over that 5-year period. So even though it'll accrue interest, if it's a 5% interest rate, you'd earn $5 a year. And you would earn a flat $5 a year because you would only earn 5% on your original $100 investment. It's a very safe type of investment, but you don't get a high return on it, right? So that means that you're not going to get rich buying bonds. But like grandparents will buy their kids bonds, right? Like, here's a gift to my grandchild the day they're born. I bought $1,000 bond. And that's because usually it'll be like, you can touch this on your 18th birthday. And because they're so safe, they're guaranteed to make some money on that bond over the next 18 years. And 18 years is a long-term investment. So they're guaranteeing that like they will earn a return on that. Versus if they go, hey, I invested in Apple for you. And if Apple gets, crushed by some other company within the 18 years, then their investment could be worth zero and their grandkid could get $0. But it's just like basically anything else, right? Low risk, low reward, high risk, high reward. And the idea is to optimize or mitigate those. How much risk are you willing to take, etc. And so usually a government bond is you're promising the government, here, use my cash. But you have to pay interest on this. And right now it's not a real great investment because you might have heard in the news interest rates are almost zero. That means when you buy a bond, it's very cheap to borrow money, meaning like if you were going to buy a house, you could get a very low interest rate on your loan. But it's also, the interest is very low the other way. If you're going to give the government money to borrow, you're gonna purchase a bond from them. You give them cash, they give you a promise to pay you back. The interest rates that they'll pay you back are very low as well. Sorry, Naomi, are there some criteria you have to meet to buy a bond? No. I mean, you have to have like a bank account, and usually you would purchase these from a bank, but no, it's not like to have an IRA, you have to have a job or something like that. You can buy a bond whenever. It's just right now it's not very fruitful to do so because the interest paid on them is so low. All right. So cash, you know what cash is, but cash isn't just physical cash, right? That you roll up and put in your pocket. It's any money you have in a checking account. A certificate of deposit is technically cash, and U.S. Treasury bills. These are all just different forms of what we call liquid cash, meaning they can be spent immediately, essentially. And we'll talk more about liquidity in a moment. All right, so things to consider about your investments. Couple of things. Liquidity. How difficult is it to take out your money? So this is something that can change throughout your life. When you're younger, generally you need most of your cash to be, or your investments to be very liquid, because you may not have that much money to save. So liquidity is ease of access. So cash is completely liquid. You can spend it anywhere, right? But something like investing in a house, right? Housing or land is generally historically a good investment, meaning over time it has gone up. Now we've had dips, right? So we had the 2008 market crash. But if we look at the trend over time, in the long run, it is a pretty safe investment to buy a house. But it's not very liquid. So I could have a house that's worth, $350,000. But if I want to get my money out of that house, it's going to take me at least a month. So if I need that money very quickly, that's not a great investment for me. And then there's stuff that are in between, right? Stocks can be kind of liquid. You can't just spend a stock, but with all these trading apps now, it's pretty easy to access your money. You can do it within 24 hours. So not as liquid as cash, but obviously much more liquid than investing in real estate or something like that. And then the other two we already talked about, risk and return. So risk is how much can you risk, and return is what can you expect on your investment. Well, when you invest in, let's say, a single stock, you can't really guarantee any return. So you're at high risk there because you don't know what's going to happen to it. If you invest in an index fund, you'll see when my dad, JT, gives his presentation, you're basically betting on the stock market itself, and the stock market over time has gone up in value. And it's, in my thought, when I initially talked to him about this years ago, was like, that makes sense because of inflation, right? Money is worth less over time, so things cost more over time. So it makes sense that over time things are more expensive, thus the stock market would go up in value. But you'll see that actually betting on the stock market outpaces inflation, meaning you are making true money. It's not just that inflation is occurring. It's making that investment is earning you true dollars back. And that's the same roughly with investing in real estate. So those are very safe investments, but those are investments where you have to be very patient, right? Those are long-term investments. You're not going to flip a quick dollar. All right. Most investments, your principal is at some sort of risk. There are those where it's not. A bond, your principal generally isn't at risk. It's safe. But the return rate is going to be extremely low. Same with just a general savings account. No risk, but barely any return. Okay, so stock market trends. We'll talk a little bit about the stock market. I'm not going to go too in depth here. But the Dow Jones Industrial Average, this is an index. Remember what an index is. An index is a single number that's meant to summarize some system. In this case, the Dow Jones Industrial Average is the average prices of stocks of what are the 30 largest companies for that day. And so it really represents kind of how the market is doing overall. If we look at this over the past 110 years, well, this is only up through like 2012, but you can see there is a pretty obvious pattern. Over time, it's going up, right? Now, there are dips in certain places, but in the long run, it's increasing. Which means if you were to invest in this index fund, in the long run, you're almost guaranteed to make money, no matter where you invested. So you could have invested here. We call that a bubble, right? 1929, when the cost was highest. And over the next couple of years, you would have gone, oh my God, my stock tanked. This was the Great Depression right here. But eventually, if you kept it invested for long enough, so let's say you just left it in for 30 years, you're going to get to above where you started. So even if you invested at the worst possible time, as long as you can leave it in there in the long run, you're going to be relatively safe. And that's because it's an indexed fund. You're betting on the health of the market itself. Now, it would be much better if you would have invested it here, right? When it costs much less. But there's no way to know that. So it's relatively safe to invest in an index fund over time, as long as you're doing it for many years. But you're not going to expect to make a ton of money over like a single year. All right, so there are two ways to make money on stocks. The easiest way, and the one that we just kind of went over, is get a capital gain. And that's where you buy a stock at a certain price, that stock goes up in price, and then you sell it at a higher price. Boom. you've made what's called a capital gain on the sale of that stock. Buy low, sell high. That's the principle, right? Hey, I bought this stock for $1 a share. Now it's at $100 a share. I'm going to sell my stock and make a profit of $99 a share. Awesome. We call those capital gains. The other way certain companies, if they're large enough, is that if you own the stock and that corporation turns a profit for that year, they will pay out some of that profit to their stockholders, and that's called dividends. So companies like Microsoft, stuff like that, that's really, really large, 3M, probably Apple, they'll pay out when they turn a profit a certain number of cents per share to their stockholders. And then you get to reap that benefit and hold on to the stock. So that's called dividends. All right, I'm going to pause here. I've been talking. All right, appreciate it to those of you giving me those emojis. That's good feedback. Okay. So this is something that's an example of, I really don't need you to memorize what a stock ticket looks like and what everything means. I'm going to give you this diagram. I'm happy if you just use this diagram on the test to answer any questions about a stock ticket that I put there. Again, investing, you have tools, you should use those tools. You shouldn't be trying to memorize off the top of your head what to do. If you were going to buy a car, I would suggest that you go and online find an amortization calculator. We'll talk about what that is once we get to loans, and use that to calculate what reasonable payments are and what that'll cost you in total. All right, Naomi, how does the owner of a corporation benefit from having stockholders? Well, so this is where we start getting extremely complicated. Once your company becomes publicly traded, there's basically a board that decides how many shares you get and what each share is worth. And once it's publicly traded, you're on the New York Stock Exchange, then you're part of this group and part of these indices where, like I said, over time the values of stocks in general increase, right? So they benefit in a couple ways. If you have stockholders, you basically have a bunch of people investing money in your company. So if I'm a company and I'm publicly traded and everybody's just buying some of my stock, then all that money is coming to me. So I have this liquid cash to keep growing my company, right? And as I can continue growing my company, hopefully I can make its stock worth more, and so on. So it's just like you're getting a bunch of little lenders to invest in your company and making you more liquid, right? And the more public you are, the more attention your company has, the easier it is to grow your business. Okay. And so then, like, the idea behind dividends, if you're a company that's big enough to pay out dividends, you're incentivizing more people to invest in your company, which is going to have the reaction of increasing your stock price, making your company worth more. All right. Now, some of the stuff, a lot of the stuff, I am not super clear on. Like, okay, how do they decide how many shares your company is worth and how much each share costs? And they have kind of a pilot period, just like a pilot TV show. Well, they're like, all right, we have this board that decided we'll put it out there at this much and see what people do. And if people purchase the stock, great, then we'll make it worth that much and we'll send it public. Otherwise, we're going to reevaluate it. So there's a whole bunch of behind the scenes stuff that happens to determine how much stock your company is worth and what each share is worth. And kind of very similar to when you want to sell your house. So I thought this was going to be a good analogy, but I realized none of you have probably bought a house. But when you want to sell your house, what you have to do is have somebody come out and evaluate it, and then they'll do what's called pulling comps. So they'll look at houses that are comparable in size and condition to yours and in a similar neighborhood, and they'll look at a bunch of those and see what those are worth, and that's how they'll determine what we should sell yours for. Okay? And so that's kind of the same way they'll approach putting a new company on the market. All right. So this diagram just tells us what a stock ticket tells us, right? So you have a bunch of information. You have the stock symbol. So Microsoft stock symbol is MSFT. You have the change in share price since the prior day's close. So this is telling me here that Microsoft has gone down 13 cents since the market closed yesterday. You have the percent change in share price due to prior day's close. So this is giving you the same information, just doing it percentage-wise. So it's gone down 0.64%. And then this is the last price a share sold for. So the last stock that sold for $19.76. And then just a whole bunch of other information. And we'll use this, we'll do an example real quick. But like open, high, and low. So open, this is what it opened at. The high today was $20. The low today so far it was $19.67. And then they give you some other information like this year's, the 52-week high and low. So that's within the last year. Let's see what else. The volume, that's just the number of shares that have been traded today. Shares outstanding, the total number of shares that exist for the company. So notice that that's in millions. So there's actually 8,889,000 shares of Microsoft out there to be traded. Dividend yield. So the annual yield of the dividend based on the current share price and dividend per share. So this is like the percent you would get per share in dividends. So you're going to get 2.61% of whatever your share is worth at the end of the year when they pay out dividends. And so the dividend paid in the latest quarter, this is in dollars. So you got paid 13 cents per share, basically. All right. So let me see what we got real quick left here. Okay, so just a couple examples. Then we'll be done with this section. So I'm going to pause it real quick, get my stuff together, and we're going to answer these questions. Okay. So let's go through and we'll just answer a bunch of these questions and analyze that Microsoft stock ticket. All right, what's the symbol for Microsoft stock? We just saw that that was MSFT. What was the price per share at the end of the day yesterday? So this one's a simple calculation. The last share sold for $19.76. It's gone down 13 cents since end of day yesterday. So meaning if we add that 13 cents to the 1976, end of day yesterday was $19.89. So different than what it opened at today. And that's just because information can be, come in overnight about a company and then it'll open at a different price than it closed at the previous day. All right. Based on the current price, what is the total value of the shares that have been traded so far today? Okay. So let's go back and let's see. Traded so far today, that's volume. The volume is the number of shares that have been traded today, and that's 33,247,937 shares. So 33,247,937 shares. And I'm just going to multiply by what their current cost is, which is $19.76. And if we pop that into our calculator, we get about $657 million. So that's not the value of the company, mind you. That is just the value of the shares that have moved today, that have been traded today. All right, so what fraction of the shares have been traded today? Well, we can go back and take a look and see the shares outstanding here is the true number of shares that the company has. So that's in millions. So there's actually 8,899,720,000 shares. And the number that have been traded today was that 33 million. So if I just divide those two, so if I do my 33,247,937, and I'm going to divide that into the total number of shares of Microsoft stock, which was 8,899,720,000. If we divide those, we get about 0.037. No, 0037, which as a decimal is about 0.37%. So less than 0.5% of the company has been moved around. So not very much movement there. All right, suppose you own 100 shares of Microsoft based on the current price and dividend yield. What total dividend should you expect to receive this year? All right. So let's see. You have 100 shares. And right now they're trading at $19.76 per share. Meaning that investment is worth $1,976. If we go back, the current dividend yield is 2.61%. So that's what you're going to get paid on the shares that you own. So we're going to get paid 2.61% on the shares that we own. So I'm going to change that into a decimal, so times 0.0261. And if I multiply that out, I get $51.57. So this is the total dividend I should expect this year. So you're usually not going to get rich off of dividends, but the nice thing about it is you can reinvest it into whatever your investments are. All right, so let's talk a little bit more about bonds. Just a couple definitions. The face value is the price you pay for the bond, also called the par value. The coupon rate is the simple interest rate that the issuer promised to pay. Now, the thing about a bond is you're basically making a contract with the bank or the government saying, here, you can have my cash, you have to pay me back, and you have to pay me back by this date. So that's the maturity date of the bond. And that's basically when you can take that cash out. So like I said, a lot of times grandparents, when their grandkid is born, they'll purchase a bond for 18 years, and then on their 18th birthday, that bond becomes mature, and they can take that cash out and use it for college or whatever it is, and it's a pretty safe investment. And then we have one formula I want you to write down at the bottom, which is the current yield. That's the annual interest payment divided by the current price of the bond. So here's kind of how the language of bonds works. The closing price of a U.S. Treasury bond with a face value of $1,000 is quoted as 105.97 points for a current yield of 3.7%. If you buy this bond, how much annual interest will you receive? All right. A lot going on here, and I know it can seem confusing. Remember what the face value is. This is what you pay. The closing price is what the bond will be worth at its maturity, but it's specifically as a percent. So this just means that, okay, it's going to be worth 105.97% of what you bought it for once it hits its maturity date. So we call that its current price. Its current price being what it's going to be worth to you at its maturity date. And so we can just use that to calculate. It's going to be worth 105.97% of its face value, so of $1,000. Which, if we convert that to a decimal, it's 1.0597 times 1,000. Which is just $1,059.70. All right, so this we call its current price. All right, the formula we had was current yield equals annual interest divided by current price. The thing that they're asking us to solve for in this case is the annual interest, right? So we want to solve for annual interest. So all we'll do is let's input the current yield and the current price, which we know. The current yield, they tell us, is 3.7%. So we're going to input that as a decimal. That's 0.037. And that equals the annual interest divided by the current price, which we figured out was $1,059.70. Remember, current price is not face value. Face value is what you pay for it now. Current price is what you get paid once it hits its maturity date, right? And now I just want to solve for annual interest. So I'm just going to multiply both sides by that 1,059.70. That'll cancel those here, and that'll leave me just with what my annual interest is. Popping that into your calculator, 1,059.70 times 0.037 is 39.21. So annually, you're going to earn $39.21 a year. All right, we're on to our last part of this. So mutual funds are when you pay a company to invest for you. So sometimes referred to as passive investing. Versus day trading is like when you are investing in individual stocks or investing on your own. You can use one of these huge companies like Vanguard and have them do the investing for you. And they generally have their own mutual funds, which are just like big index funds, right? Where they invest in a whole bunch of stocks. So the most important factors are they're going to charge you a fee to do this because they're basically doing all the research for you. And then the reason they're able to charge you a fee is because they will have a history of how well they did. Like what is your return rate? Oh, we generally earn about 7% return, meaning whatever your investment is, pretty regularly, we're going to earn you an additional 7% on top of that. And those will be well above what you can earn from just putting your money in a savings account, which is like 2%, right? But there's a little more risk involved. And so the note there is that they will tout their past performance, but as we know, the market is very complicated. And if you have something like a housing market crash, that can affect the market very negatively, in which case all the stocks go down, and then so do the index funds. So you have to be kind of willing to leave your money in there in the long run. So past performance is no guarantee of future results. And so these will be listed in as like a stock ticket format as well. They'll have slightly different categories, but again, I'm fine. Just pull down the PDF of this set of slides, 4C, and have that ready for when you do things like take the open note quiz or take tomorrow's quiz, and you can just reference these right here. They'll tell you what each part of the ticket is telling you. So this is an example of a Vanguard mutual fund or a Vanguard 500 index fund. So remember, an index fund just takes a bunch of stocks and lumps them together. So we have the symbol and a bunch of other information about how well the stock is doing. So the net asset value, this is essentially the stock price, but because what you're investing in is not one stock, you're investing in 500 stocks all at once. It's not called a stock value because it's not just one stock. All right. So let's do one last example. Based on the Vanguard 500 mutual fund quote shown on the previous slide, how many shares will you be able to buy if you decide to invest $3,000 in this fund today? And so a lot of times when you invest in a single stock, you can't invest in a partial stock. In mutual funds, you can. And this is as easy as, okay, well, we're investing $3,000, and what do these cost per share of the index fund? I'll just divide it into that. We said it's $83.83. So if I divide that out in my calculator, we end up with about 35.8 shares. Other than the fact that you are betting on 500 stocks at once and you're letting this company adjust which 500 stocks they're betting on for you, it works pretty much the same way as investing in a single stock does. You have this price. This is how much a share costs to invest in this index fund. You would like to buy it at that price, and then hopefully over the years that price goes up and you can sell those shares, and then you make capital gains. You make the money, the difference in the money that you bought the shares for and the money that you sold the shares for. There's your profit. There's your capital gains. So those are the basics